Hi everyone. Today I'm going to be talking about variances, which also happens to be one of my favorite topics. Variances are quite simple, but if misunderstood or not taken seriously, they can be very difficult. But I'm here to make it as easy as possible for you. So variances are there in your paper F2, that is where it starts, and then it builds on an F5. And to some extent, it is also used in your paper P5, that is Advanced Performance Management. So in this video, I'll explain to you the basics of variances, what they are, and then we'll have more videos after this where I'll discuss each of the variances in detail. As usual, if you have any queries or comments at the end, please leave them in the comment section or you can email me. Right. So when it comes to paper F2, there are different types of variances. You have material variances, labor variances, sales, variable production overheads, and fixed production overheads. Within each of these categories, the variances are further divided into different types. So material will be having 3 different types of variances, labor will be having 4, sales will be having 3. Likewise, variable production overheads, there are 3, and fixed production overheads, 5. So as you can see, there are quite a lot of number of variances here, 18 in total. However, don't worry, these are not 18 very different types of variances. A lot of variances are similar in nature to one another. So it reduces the different types of variances that you're actually going to study. When you go on to paper F5, all the variances from your F2 are part of F5. So when you progress in ACCA papers, there's something known as known knowledge. The term known knowledge means whatever you have studied in a relevant paper before is expected to be known knowledge in the existing paper. So your F2 variances knowledge is supposed to be known knowledge in your F5 paper. So you have all the variances from F2. In addition to that, you have something called planning and operational variances. Planning and operational variances aren't a new type of variances. They are simply splitting your existing variances into controllable and uncontrollable activities. Then you have something called market size and market share variances, which is again something similar to planning and operational variances. The new type of variance calculation will be your mix and yield variances. These are particularly related to your material variances. In contrast to F2, where you're dealing with a single material at a time, in this case, you'll be dealing with a mix of 2 or more materials, and hence your variance calculations are slightly different. Moving on, what exactly are variances? You may see a number of formulae and descriptions, but in very simple terms, variance means nothing but a difference. It is difference between what you had planned, what you had expected, and what the actual outcome was. For example, you may be studying for a particular paper and you planned to achieve 80%. When you gave your exam, you expected to get, say, 85%, and your actual outcome was 90%. So there's a difference between what you had planned, what you had expected, and what your actual outcome was. So calculating these differences between the different outcomes is what we call variances. And because there is a difference, that difference can either be favorable or it can be adverse. For example, whatever you wanted or whatever you were expecting, if you get a better result than that, the difference in that result is going to be favorable. For example, you were expecting to get 75%, but you got 80%. There's a difference of 5%, and this is favorable because you got more. But if this was a cost, you were expecting a cost of 75 but got a cost of 80. Cost is something that everyone wants less. In this case, that additional $5 extra is an adverse variance. So this is a very important point here. Remember, your variances will always either be favorable or adverse, and we denote them by the letters F or A. If there is no difference, it can neither be favorable nor adverse. If your difference is 0, it's simply 0. But if there is a variance, it has to be either favorable or adverse. If you simply denote a variance as a number, that doesn't make sense because we don't know whether it is favorable or adverse. Lastly, formulae are important. You will get some formulae for variances in order to calculate that, but don't stress too much on that. The reason I'm saying this over here in the beginning is because I've seen a lot of students focusing so much on the formula and trying to calculate a variance as a positive number or negative number that they actually forget to apply something which is important called logic. So the logic that I just explained to you earlier, that you wanted something and you got more, and that might be favorable depending on what it is. For example, if it's profit and you got more profit, that's favorable. But at the same time, if it is cost and you got more cost, it is adverse. You have to understand that logic here and then decide whether something is favorable or adverse, rather than simply relying on formula and calculating a positive number and a negative number and then trying to remember where a positive number is favorable and where a positive number might be adverse. So don't focus on that, simply focus on logic. If you're getting more of what you wanted, it may be favorable. If it is more of something that you did not want, like cost, it may be adverse. So I hope the introduction was useful. I'm going to leave some explanation about the different type of variances in the description of this video. Please feel free to read through that. And as we have more videos discussing the actual variances in detail, these descriptions can become more helpful. Thank you.